everyone. Welcome to our final video. This one is about errors. Very exciting, I know. Not my favorite thing either. This is on page 367, problem 6-36B. And the reason I'm showing you this one is a lot like the second lab that you're going to have to do. And it is also like a homework problem you have, which is exercise 623. Also, there's quite a bit that deals with the error. And it's just like the example we saw on page 340 with the 3 years. And they give you a little scenario. For this one, the scenario is, it's in the book on the bottom of 367, that this carpet company had this data for 3 years, and in 2020, the auditors found a problem, right? That in 2017, inventory was understated, which is their way of saying too low, by $8,000, and that ending merchandise inventory in 2019 was overstated or too much by $9,000. Ending inventory in 2018 was correct. So they want us to show the effects that it has on these 3 income statements and do a corrected version. These are material mistakes, so they do make a difference. So we're going to start out with this net sales revenue for all 3 years, and I'm just going to copy it. 212 for 2019, 161 for 2018, 170 for 2017. Okay, so that's our net sales revenue. Now we'll start with the beginning inventory. Okay, the beginning inventory started at 41,000. So I'll see if I can stay on my line for kind of sorta. I'm a little high. Cost of purchases 86. And the total 127. Let me make sure I'm on the line still. Cost of goods available. Yep. Now our first error was the ending inventory in 2017. They told us that it was overstated by 8,000. So it was 28, right? So, nope. Oh, I'm sorry. It was understated by 8,000. I'm reading 2019. It was understated. So we have to add to it. So in the book or on the computer, when you're looking at the computer for a problem like this, it was at 28. We're going to add 7,000 to it. So the ending inventory should be at 36,000 when we add that in. Okay, that's our ending inventory. Okay. Not what we had in before the error was corrected at 28. Notice I added 8,000 to that to correct the error. So that means cost of goods sold would be, here it's 99, it actually should be 91,000. So that made cost of goods sold go from 99 down by $8,000. So cost of goods sold is less, so gross profit's going to go up. Gross profit should be 79. Sales minus cost of goods sold, right, equals gross profit. And not what they had at gross profit 71. So again, the $8,000 gets added to gross profit because cost of goods sold was $8,000 less. Because again, they had the inventory too high. The operating expenses is still the same, 39. So net income, 40,000. So that's it for, we've corrected 2017. Of course, when you do an error in 1 year and you have the wrong ending inventory, then have the wrong beginning inventory for the next year. So we have to correct that beginning inventory up to 36,000. If you look, it's only 28, right, in your problem before correction. So we're gonna make the correction in the beginning inventory for 2018. Notice how the error carried over and now we're fixing it. Okay. Cost of purchases, 100,000. So available is 136. Available for sale. Ending inventory was correct for 2018, so we don't have to change that. 22,000. Okay. So cost of goods sold would be 114 instead of 106. Again, that $8,000 error that got carried over before we changed the beginning inventory to what it should be. Okay? Not 28, but $8,000 more. So it affects our cost of goods sold. So gross profit now is going to be, instead of 55, it's going to come down by 8,000 to 47,000. So, oh, I forgot to put operating expenses. I'm sorry. Too quick. 28,000 for operating expenses. This is supposed to be a comma. I don't know what it looks like. So we have our gross profit minus our operating expenses. Again, gross profit went from what it was, 55, it came down because we adjusted up for the beginning inventory from that error from last year. So we have $19,000 net income, which is $8,000 less than we had before, okay? We had 27. So now we're going to take our ending inventory and bring it up to beginning for 2019. So there was no difference, it was still 22, so we don't have to do anything, just bring the ending inventory to the beginning. And the cost of purchases, 131. Inventory available for sale, 153, that's all the same. Ending inventory, there was a mistake in 2019 and it was overstated by $9,000, so we have to bring it down by the 9,000. Instead of 34 for ending inventory, it comes down to 25,000. So they overstated or too much by 9,000, so we have to put in the correct ending inventory, which is going to give us a better gross profit by 9,000. Instead of 93,000, right, that they have here, we're going to have gross profit, actually we're going to have less, I'm sorry. Oh, that should be 119, yep. We're going to go down to 93 from, take away the 25, we have gross profit of 84 instead of the 93, that's the 9,000. Sales minus cost of goods sold equals gross profit. Gross profit is 84. Operating expenses 63. The same. Net income, instead of being 30,000, it's going to come down by that $9,000 mistake that we did and we just corrected. Overstating our ending merchandise inventory is actually less, so we sold more. That's why cost of goods sold went up by 9,000. So net income comes down by 9,000, 21,000. So we fixed all three errors. Going to let you do the ratio problems yourself because they're very self-explanatory, as I say, just like the Coles one. But the last thing I wanted to show you before we wrap this up, I think they're asking state whether each year's net income before your correction was under or overstated and indicate the amount. It's kind of funny because two of the things they already told us, but they didn't say anything about 2018 except there was no change except the carryover error. So I'm going to put 2019, right, Correct net income, 21,000. Okay. This is correct. I'll put C for correct net income. And then incorrect, I'll put INC. And that was 30, I'm sorry. We originally had 30, so that would be an overstatement or too much. I'm abbreviating of 9,000. I think they have it in brackets like that for the overstatement. I think that's the way they present it for 2019. They overstated net income because, again, the inventory was understated. So that's 2019. 2018, I'm just putting this because I know in at least the lab problem they're going to ask you this. The correct net income was 19,000, as we just did. And the incorrect was 27,000. That's the $8,000 mistake from the year before. So it's overstated by 8,000. I'm just going to put over here. I'm getting kind of messy. In 2017, let's see, we can see that, right? Kind of, sort of. The last one for 2017 was the correct net income. We got 40,000. I'm sorry, I'm running out of space. The incorrect INC net income, I am definitely running out of space, is 32,000. Okay, so we had an understatement of 8. Now they already told us about 2019 overstated by 9,000 and 2017 understated by 8,000. They told us that in the explanation for what we went by, but they didn't tell us anything about 2018 except the ending inventory was right. But when you make an error, it carries over to the next year. Okay? And that's what happened. Again, the last requirement is the ratio problem. Just follow the one in the book from Coles. It's very, very easy. The number of times the inventory turns over and how many days each turn takes. Okay, so I've kind of had it. So that's going to be it for tonight, guys. And let me know if you have any questions or any problems at all. We'll be chatting. And I'll see you back here for the next chapter, which will be 10. Bye, everyone.